Have you ever stopped to think about the quiet giants moving our economy? The companies working behind the scenes, making sure global supply chains actually function.
It's a great question because often they are invisible, right? But absolutely critical.
Exactly. And today we're diving deep into one of those powerhouses, a company that's been shaping logistics for, well, over a century now, GATX Corporation. That's NYSE, ticker GATX.
Yeah, GATX, a premier global lessor, mostly transport assets, and their history is incredible, founded way back in 1898.
Wow.
What really sets them apart, I think, is this pure play, full-service focus. Mainly rail cars, locomotives too, and interestingly, a growing business in aircraft spare engines.
So they're providing the actual hardware that keeps things moving.
Pretty much the essential infrastructure.
Okay, so our mission today, for you listening, is a really comprehensive, unbiased look at GATX. We want to unpack what makes their business tick, the fundamental quality.
Look at their competitive edge, their financials.
Right. Financial strength, and critically, where the valuation stands right now. The idea is to give you the foundational insights, the key nuggets, to really assess GATX's potential for long-term value.
And maybe uncover a few surprising things along the way. It's a fascinating company when you start digging in.
Let's do it. So 125 years.
Yeah.
That's incredible longevity. How does a company like that not just survive, but thrive for so long?
Well, it's about evolution, adaptation, but a core part right from the start almost has been this full-service lease offering. And this is really key. It's not just, here's a rail car, see you later. No, they bundle it. Comprehensive services, we're talking routine maintenance, making sure everything's compliant with regulations, which is huge, and rail handling taxes, all the tricky stuff. Ancillary support.
So they take a lot of the operational headache away from the customer.
Exactly. It becomes more of a partnership, a high-touch, solutions-oriented relationship, as they call it. It builds loyalty that goes way beyond just the price tag.
Yeah, I could see that. Makes it harder to just switch providers if GATX is basically managing a big part of your logistics operation for you.
That's the competitive advantage right there. It's sticky. And underpinning all this is the nature of their assets. They're asset-heavy, obviously. Primarily rail cars.
And these aren't assets you replace every few years.
Right. Not at all. Exceptionally long economic lives. Think 35 to 50 years for a rail car.
50 years. Wow.
Yeah. And the beauty of that is, over that lifespan, GATX can lease that same car out multiple times to different customers, potentially for different uses after modifications.
So the cash flow from one car can eventually far exceed what they initially paid for it.
Significantly exceed it. It generates these incredibly predictable, almost annuity-like cash flows. It's a long game, all about disciplined management of that asset through its entire life cycle.
Which means they need expertise in everything from buying the right cars, structuring the leases, maintaining them, modifying them.
And then deciding when to remarket them for another lease or when it's time to strategically scrap it and get the maximum residual value. It's a very involved process.
Okay, let's break down the business. Where does the revenue actually come from? You mentioned segments.
Right. So the biggest piece, the real cornerstone, is Rail North America. This is where most of their revenue and profit comes from.
Right.
As of the end of 2024, they had over 111,350 wholly owned rail cars just in North America. The net book value on those was about $7.4 billion. It's massive.
And I assume it's not just one type of car.
Oh, absolutely not. Very diverse fleet. You've got tank cars essential for liquids, gases, chemicals, petroleum. Then freight cars like covered hoppers for grain, plastics, that sort of thing. Box cars too.
So they're serving a really broad slice of the industrial economy. Chemicals, oil and gas, food, agriculture.
Exactly. And that diversification is crucial. It helps insulate them. If one specific sector, say petroleum, has a downturn, agriculture might be booming at the same time.
Makes sense. How's the performance been in North America?
Really strong. In 2024, fleet utilization, excluding the more volatile boxcar segment, was 99.1%.
99%. That's basically fully utilized.
Pretty much tells you these assets are in constant demand. And their lease renewal rate was 85%. That signals really strong customer retention. People stick with GATX.
Why do you think that renewal rate is so high? Is it just the full service aspect?
That's a huge part of it, but it's also the reliability, the network effect. They have this sophisticated maintenance network, did over 28,900 service events in 2024 alone. That operational scale is hard to beat.
Okay, so North America is the core.
Yeah.
But they're global, right? What about Rail International?
Right. Rail International is their key pillar for long-term growth and geographic diversification. Think GATX Rail Europe, GRE, and GATX India.
Are those growing faster?
Often, yes. They're benefiting from some strong secular trends. In Europe especially, there's a big push from governments towards sustainable transport, shifting freight from trucks to rail. That means investment in infrastructure and demand for modern rail cars.
Ah, the ESG angle driving demand.
Exactly. And GATX is capitalizing. GRE's fleet is over 30,000 wagons now, and India crossed 10,000 wagons in 2024. Utilization is high. Renewal rates are increasing there too. It's a good growth story.
Okay, rail dominates. But you mentioned something else. Engines.
Yeah, engine leasing. This used to be part of a broader segment called portfolio management, but now it's laser focused on aircraft spare engines. It's a niche, high-value market.
How does that work? Who are they leasing engines to?
Airlines, MROs, maintenance, repair, and overhaul facilities. It's done through two main structures. One is a 50-50 joint venture with Rolls-Royce called RRPF. The other is their wholly owned GATX engine leasing, or GEL.
And how's that business doing? Tied to air travel, I assume.
Directly tied. And 2024 was huge. Global air travel fully recovered and even surpassed pre-pandemic levels. So demand for spare engines was incredibly strong.
Makes sense. Planes flying more means more engine maintenance, more need for spares.
Precisely.
Yeah.
And GATX leaned into it. They invested over $1.16 billion, combined $900 million through the JV, $260 million directly just to grow those engine portfolios in 2024. It shows they can apply their leasing expertise to other valuable, long-lived transport assets.
So pulling it all together, this full service model, the long life assets, the diversification across rail types and geographies, plus engines, what's the defining characteristic of GATX's revenue stream?
Predictability, that's the word. Highly predictable, annuity-like revenue, because you have these long-lived, absolutely mission-critical assets locked into long-term lease contracts.
And that's the big difference compared to competitors like Trinity or Greenbrier.
It's a fundamental difference. Trinity and Greenbrier have large manufacturing arms. Manufacturing is notoriously cyclical booms and busts. GATX's revenue is much, much smoother because it's based on those existing leases.
Do we have a sense of how much future revenue is already locked in?
Yeah, get this. As of the end of 2024, just their North American rail fleet had $3.8 billion in contractually committed future lease payments.
$3.8 billion. That's incredible forward visibility.
Exactly. It allows them to plan, to invest, to manage debt with a degree of certainty most companies can only dream of. That predictability is really the core of their high business quality. It's why investors often award them a premium valuation.
Okay, that sets up the core strengths perfectly.
Yeah.
Now let's frame the investment case. Every story has two sides. Let's start with the bull case. What are the strongest arguments for GATX right now?
Well, the foundation is that durability and predictability we just hammered home. The annuity-like cash flows, proven resilient time and time again, and of course, the dividend.
That amazing dividend record.
Unbelievable. Uninterrupted quarterly dividends since 1919. Think about that. Through everything, wars, recessions, depressions, pandemics, it's more than just a payout. It's a testament to their financial discipline and the stability of the core business.
Hard to argue with over a century of consistency. But what about recent developments? What's new that strengthens the bull case?
The big one. The absolute game changer is the recent joint venture with Brookfield Infrastructure to acquire Wells Fargo Rail's portfolio.
Right, the WFR deal. How significant is that?
Transformative isn't an exaggeration. It's set to nearly double GATX's managed fleet. We're talking around 215,000 rail cars under management post-deal.
Doubling the fleet. That's massive consolidation.
It solidifies them as the undisputed #1 in North America. Their pro forma market share jumps to roughly 25%.
25% market share. What does that kind of dominance allow them to do?
It creates significant advantages. Network affects more cars means more efficient routing and utilization. Enhanced purchasing power, they get better deals on new cars and parts. And crucially, more pricing influence. They have more sway in setting lease terms and rates.
So more scale equals more power, basically.
Basically, yes. And add to that the favorable industry backdrop, high barriers to entry, which we'll get into, and what management calls rational competitive behavior, meaning competitors aren't just slashing prices irrationally. This leads to a strong lease rate environment.
Meaning they can charge more when leases renew.
Exactly. They're repricing older leases at today's higher market rates, locking in better profitability. Throw in management's proven track record of disciplined capital allocation and strong shareholder returns, and the bull case looks pretty robust.
Okay, it sounds compelling, stable core, incredible dividend history, and now this massive acquisition boosting their market leadership and pricing power. But let's flip the coin. What's the bear case? What are the risks and concerns?
Well, despite the stability of the contracts, you can't ignore the cyclical exposure. At the end of the day, GATX's business is tied to the health of the industrial economy and freight volumes.
So a recession would still hurt them.
Absolutely. A significant downturn means lower demand for goods, less shipping, lower railcar utilization, less demand for new leases, and pressure on renewal rates. Those long-term contracts help smooth things out, but a deep or prolonged recession will impact them. They're not totally immune.
Okay, that makes sense. What else worries the bears?
Capital intensity and leverage. This is a business that requires huge amounts of capital to buy and maintain assets, and they use a lot of debt to finance it.
Which makes them sensitive to interest rates.
Very sensitive, especially now with the substantial debt taken on, well, guaranteed by GATX for the Wells Fargo rail acquisition. Their debt-to-equity ratio was around 3.5 times in mid-2025.
Is 3.5x high?
For an industrial leasing company backed by tangible, cash-flowing assets, it's manageable, even normal. But it does mean rising interest rates increase their financing costs, which can squeeze profits. The WFR deal definitely amplified this sensitivity.
So the WFR deal is a double-edged sword. Huge strategic positive for the bulls, but adds leverage risk for the bears.
Exactly. And it's not just leverage, there's integration risk. Merging such a massive portfolio isn't trivial. But even more fundamentally, there's the shift in fleet composition.
What do you mean? How does the fleet change?
This is critical. GATX historically built its reputation on the stability of its large tank car fleet cars for chemicals, petroleum, less cyclical stuff. The Wells Fargo portfolio is heavily weighted towards freight cars. Post-deal, about 65% of GATX's North American fleet will be freight cars.
And freight cars are more cyclical.
Generally, yes. Think cars for construction materials, frac sand for energy, maybe even coal. These markets can swing much more dramatically with the economy than, say, food ingredients or basic chemicals. So the new GATX is bigger and more dominant, but potentially more volatile.
Interesting trade-off. More market power, but maybe a bumpier ride earnings-wise.
No.
Any other bear points? Competition.
Competition is always there. Trinity and Greenbrier, the integrated players. Because they also manufacture cars, they could theoretically subsidize their lease rates with manufacturing profits to gain share.
Could that pressure GATX's pricing?
It's a potential long-term risk, though, as we said, GATX is also a huge customer for their manufacturing arm, so it's a complex relationship, but the threat exists.
So wrapping up the tension, it's really balancing that high-quality recurring revenue against the unavoidable economic cycles and the significant financial leverage, especially post-WFR.
That's the heart of it. The Wells Fargo deal dials up both sides of the equation. It massively boosts their scale, moat, and long-term cash flow potential. But it also adds debt and increases exposure to those cyclical freight markets. The investment thesis really hinges on whether the huge strategic benefits outweigh those amplified risks. It's a bolder GATX now.
Okay, let's widen the lens again. Talk about the industry itself. How big is this railcar leasing market and what's driving its growth?
It's a very large, very essential market. Global projections see it growing somewhere between, say, 5% and 9% annually over the next decade. North America is the biggest piece of that pie.
What's fueling that growth? Why are companies leasing rail cars more?
Several key things. One, cost. Leasing avoids the huge upfront capital cost of buying cars, freeing up cash for shippers. Two, flexibility. You can adjust your fleet size based on demand much more easily if you lease.
Right, you're not stuck with idle assets in a downturn.
Exactly. Then there's the underlying demand for rail itself, driven by industrial production, trade, e-commerce, logistics, and increasingly, sustainability is a big factor. Rail is way more fuel efficient than trucking for long distances, lower emissions. Companies are factoring that in.
Makes sense. But the health of leasing depends on the health of the railroads themselves, right? What's the picture there currently?
It's a bit mixed, nuanced. Looking at recent North American rail traffic data, we see modest growth overall year over year. The big strength has been intermodal containers and trailers on flat cars.
Driven by consumer spending, imports.
Yeah, consumer goods, imports, companies restocking inventories, that's been strong. But traditional carload traffic, the kind GATX specializes in, has faced headwinds.
Like what?
Well, the big one is the long-term structural decline in coal shipments. That's a headwind for railroads overall. And some recent softness in manufacturing has impacted demand for moving raw materials and finished goods.
So how does that impact GX specifically? If intermodal is strong, but carloads are softer.
It's less direct. GATX doesn't have a huge exposure to intermodal cars. Their core is tank cars and covered hoppers. The key drivers for them are chemicals, petroleum, plastics, agriculture. And those segments have generally held up better, shown more resilience than, say, coal or autos recently.
It's a good distinction. Now, the competitive landscape, you said it's shifting. Who are the main players besides GATX?
The main competitors are Trinity Industries, TRN, Greenbrier, GBX, and another large player, AITX.
And the key difference is the business model. GATX is pure leasing. The others also build cars.
Right. GATX owns, manages, services the fleet. That's their focus. Trinity and Greenbrier are integrated. They have huge manufacturing operations plus leasing arms. It's that dynamic where GATX buys cars from them but also competes against them for leases.
A complex relationship. But the Wells Fargo deal really shook this up.
Fundamentally, before the deal, GATX and Trinity had roughly similar-sized owned fleets in North America, around 110,000 cars each. Greenbrier was much smaller and owned leasing fleet.
And
After WFR, JTX's managed fleet balloons to about 215,000 cars. Their market share jumps to around 25%. The next closest competitors are down in the 12-14% range.
So it goes from a somewhat balanced oligopoly to GATX being the clear, dominant leader.
Exactly. That gives them, as we discussed, much more influence over market dynamics, pricing terms, plus the benefits of scale network effects, data analytics for managing more assets, purchasing power. It should lead to more stable, probably superior returns over the long haul.
And is it easy for someone new to come in and challenge them? What about barriers to entry?
They are formidable, massive barriers. First and foremost, capital intensity. You need billions, literally billions, to build a competitive fleet from scratch. A single new car is over $100,000.
Okay, so that weeds out most potential entrants right away.
Definitely. Then you need the operational expertise and network. You can't just buy cars. You need a continent-wide system for maintenance, repair, logistics, physical shocks, specialized labor, complex tracking software. That takes decades and huge ongoing investment to build.
So it's capital and know-how.
And relationships. Deep, long-standing customer relationships with the big shippers and railroads are critical, hard to replicate quickly. And finally, regulatory compliance. Rail, especially hazardous materials transport, is incredibly complex legally. Safety, environmental rules, you need deep expertise and systems just to operate legally.
It really sounds like a fortress. Huge scale, the full service model, operational expertise, customer ties, regulatory hurdles.
It's an exceptionally wide and sustainable moat. And the WFR deal just made the walls higher and the moat wider. Plus, the assets themselves don't really become obsolete quickly. These cars last decades. It's a very well-defended competitive position.
Okay, let's pivot to the financials underpinning all this. How has GATX performed historically, say, over the last decade or so?
Well, the key theme is consistent profitability and really robust cash flow generation. There are cycles, sure, but they navigate them well. Recent years have been particularly strong. They actually hit record earnings per share in 2024.
Can you give us some numbers? How have revenue and income trended recently?
Sure. If you look at 2021 through 2024, revenues grew nicely, from about $1.26 billion to $1.59 billion. But net income more than doubled in that period, went from $143 million to $284 million.
Doubled. What drove that big jump in profit?
A big part was fleet growth, but crucially, it was the very strong lease rate environment. As leases came up for renewal, they were able to sign new ones at significantly higher rates. That dropped straight to the bottom line. Profitability metrics look good, too. Return on equity was up to 12.1% in 2024.
Shows they're generating good returns on their capital base. What about cash flow? You said that's key.
Absolutely critical. In 2024, they generated $833 million from cash operations, combined with proceeds from selling off older assets. That consistent, strong cash flow is what fuels everything new investments and those shareholder returns. It's the engine.
And the balance sheet. Lots of assets means lots of debt, I imagine.
That's right. It's the nature of the beast. Total assets grew to over $12 billion by end of 2024. And yes, significant debt supports that. The debt-to-equity ratio, as mentioned, was around 3.5x mid-2025.
Which sounds high but needs context.
It needs context. It's backed by those tangible income-producing assets with long-term contracts. So while the number looks big, the risk profile is different than for, say, a tech company with similar leverage. But it's definitely something to watch, especially regarding interest rates.
So how does management decide where to put all that cash flow and debt capacity? What's their capital allocation strategy?
It's very disciplined, very balanced. Priority number one is fleet investment. They invested a record $1.67 billion in 2024. But it's not just spending money, it's a bottoms-up approach. Business units identify specific opportunities for assets with good risk-adjusted returns.
So they're selective about where the capital goes.
Very. They buy new cars through long-term deals with manufacturers like Trinity, ensuring supply. They also buy opportunistically in the secondary market. And of course, the WFR deal was the biggest recent strategic allocation, about $4.4 billion transaction value.
Okay, reinvesting in the core business. But that dividend, that must be a huge priority too.
It's practically sacred at GATX, uninterrupted since 1919. 14 straight years of increases. Over the last 10 years, ending 2024, they returned $3.8 billion to shareholders via dividends and buybacks. It's deeply ingrained in their culture.
That's a serious commitment. How do they manage the debt side of the balance sheet prudently?
Key is staggering maturities. They don't have huge chunks of debt coming due all at once, spreads it out over many years to reduce refinancing risk. They also maintain access to various debt markets, unsecured notes, asset-backed securities, giving them flexibility. Good treasury management is crucial here.
So overall, it sounds like a strategy that balances growth with shareholder returns, enabled by that predictable cash flow.
That's the takeaway. They managed to reinvest significantly for long-term growth while providing those consistent growing returns. It's a balancing act they've performed very well for a very long time, which builds a lot of confidence in management.
Definitely. Okay, looking forward now. How does GATX plan to keep growing, and how sustainable is that moat we talked about? Beyond WFR, what are the growth levers?
Well, continued fleet expansion and optimization is central. The WFR deal was huge, but they're always looking. Organic growth comes from that disciplined investment program, securing future deliveries via those long-term supply deals. They're planning ahead.
And you mentioned optimization, selling older assets.
Exactly. They actively manage the portfolio. Selling older or less desirable cars into the secondary market does a few things. It keeps the fleet modern, generates cash to reinvest in better returning new assets, and brings in significant income, about $120 million in remarketing income in 2024.
That's not insignificant. What about international growth? Europe and India.
Still key long-term vectors, less mature markets, strong government support for rail, especially in Europe for environmental reasons. GATX has leading positions there, so they're well placed to ride that secular growth wave. It also provides important diversification away from just North America.
Is technology playing a bigger role now?
Increasingly so. Think telematics, IoT sensors on the cars, AI for predictive maintenance.
How does that help?
Better efficiency, real-time tracking of location and condition, minimizing downtime through predictive maintenance fixing things before they break. It improves utilization and allows them to offer enhanced data services to customers. It's about making the assets work smarter, which strengthens their service offering and moat.
So the moat seems pretty secure. Scale, service model, expertise, relationships, now tech.
Exceptionally wide and sustainable is how I'd put it. WFR just cemented their leadership. The assets don't face major obsolescence risk. The barriers remain incredibly high. It's a very durable advantage.
You mentioned earlier the WFR deal signaled a shift in strategy, from steady organic growth to something more aggressive.
I think that's fair to say. Historically, GATX grew steadily, maybe smaller bolt-on deals. WFR was a massive step, $4.4 billion. It shows a willingness to make big, consolidating moves when the opportunity arises.
And it was a unique opportunity.
Seems like it. A large, high-quality fleet, 97% utilized, being sold by Wells Fargo, who wanted out of the business. GATX saw a chance to take a huge leap in scale.
And the way they structured it with Brookfield was clever.
Very astute. The joint venture gave GATX operational control immediately, bringing the assets onto their platform. But initially, they only put up 30% of the equity. That preserved balance sheet flexibility. And they have options to buy out Brookfield later.
So less upfront risk, operational control, future upside.
Exactly. It signals a more proactive, maybe more aggressive management team willing to leverage their platform and capital access to really shape the industry. Could mean faster value creation going forward than maybe we've seen historically.
Fascinating evolution. Okay, let's get to the bottom line. Valuation and risk reward. How does the market value GATX today? What are the multiples?
Right now, mid-2025, the PE ratio is hovering around 19.5 to 20. But that PE has been volatile, historically seen it as low as 5x in bad times, over 25x in booms. Reflects that cyclical perception.
Okay, what about other metrics? EBITDA, price to book,
EBITDA is around 14.7, price to book is about 2.2.
and the dividend yield,
Yeah.
given its history.
Forward yield is around 1.6%. Not super high in absolute terms, but you have to factor in the consistency and growth. That 100-plus year track record adds immense value for income investors.
Beyond multiples, how do you think about GATX's intrinsic value?
Well, given the assets, you can look at asset-based value. Replacement cost is huge. A new car is $100 plus baked $1 out. They had nearly 150,000 pre-WFR. You're talking tens of billions in replacement value. Their current enterprise value, around $13.7 billion, seems well supported by tangible assets.
And price to book of 2.2 suggests the market values the earning power of those assets, not just the steel.
Exactly, which leads to normalized earnings power. They consistently generate earnings through cycles because of the long leases and their ability to renew at market rates. That lease price index, LPI, being up almost 27% in late 2024, shows real pricing power. Plus, those consistent gains from selling assets, maybe $110 million a year, add to earnings.
And if you broke it down by segment, sum of the parts.
You'd see value in each piece. Rail North America, dominant, stable cash flow, commands a premium. Rail International, high growth story, deserves a growth multiple. Engine leasing, valuable aerospace exposure, diversification. Put it together, and the whole seems worth more than the individual parts due to synergies in management.
How does this stack up against peers like Trinity and Greenbrier? Premium or discount?
It's nuanced. On EV/EBIT, GATX's 14.7 looks higher than Trinity's 11.2, but
Yeah.
GATX's EV includes a lot more asset-backed debt, and more importantly, GATX's EBITDA is higher quality, almost all stable lease revenue versus peers' volatile manufacturing profits.
So you can't just compare the headline numbers directly.
Not really. You have to adjust for the debt structure and the quality of earnings. If you look at it on a cash earnings basis, GATX might actually be more attractive than the simple EV/EBITDA suggests. The market rightly puts a higher multiple on GATX's more stable earnings stream.
Okay, let's talk risks. What are the biggest ones investors need to watch?
Number one is still cyclical exposure. A bad recession will hit demand, utilization, and lease rates. Number two, asset residual values. If demand shifts permanently away from certain car types or the used market gets flooded, the value of their fleet at lease end could fall, leading to write-downs.
And regulatory risk.
Always present. New safety or environmental rules, especially for hazardous materials, could force expensive fleet upgrades or increase compliance costs. That's an ongoing operational risk.
What about financial risks, especially with the leverage?
Interest rate sensitivity is key. Higher rates mean higher financing costs for new assets and refinancing existing debt. That directly hits the bottom line. Credit risk is another. Customer defaults rise in downturns. And refinancing risk, they rely on open capital markets. A market freeze up or a credit downgrade would make funding difficult and costly.
So plenty to monitor. What could push the valuation up or down from here?
Catalysts for multiple expansion, positive. A soft landing for the economy, avoiding recession. Smooth, successful integration of WFR, proving the strategy right. Continued strong lease rates, positive LPI. And of course, falling interest rates would be a big help.
And catalysts for contraction, negative.
A sharp recession, a big spike in interest rates, major problems integrating WFR, maybe cost overruns or operational hiccups, or a structural decline in a key commodity they transport, leading to asset impairments.
Okay, super helpful. For listeners tracking GATX, what specific metrics should they keep an eye on?
Definitely company specifics. Watch GATX fleet utilization. If it drops below 98% consistently, that's a flag. GATX renewal success rate, a dip suggests pressure. And the GATX lease price index, LPI, if that flattens or goes negative, it signals weakening rates.
What about broader indicators?
Industry data. AAR weekly rail traffic, especially for GATX's key commodities like chemicals, petroleum, grain. Macro data. ISM manufacturing PMI, below 50 is bad news, industrial production index, and benchmark interest rates like the 10-year Treasury. And finally, keep tabs on competitor performance. Trinity's and Greenbrier's earnings, order books, commentary give context on the whole sector.
Fantastic. What an incredibly detailed look at GATX. We really explored that dual nature, the century-old stability versus the bold consolidating move with WFR, the strength of the model, the moat. It's all much clearer now.
Yeah, it's a company with a remarkable past, but it's definitely not standing still, taking a calculated risk to secure its future dominance. It's a compelling story to follow.
Absolutely.
So as you, our listener, think about GATX's journey from that steady, predictable lessor to this consolidating industry, tight in hand, maybe the key question is, how does this bigger, stronger, but maybe more cyclically exposed GATX navigate what comes next? And what does this bold move signal about capital allocation, these big traditional infrastructure sectors? What really stands out to you about how GATX is shaping the future of our supply chains?